Welcome to the deep dive. We're looking at a market that's quiet on the surface, but incredibly sensitive underneath, especially in this post-holiday period. And our mission today is pretty straightforward. Cut through that noise and find the real signals driving decisions right now.
And looking at the sources, there really are two big ones.
Exactly. On one side, you have these deep technical moves from the New York Fed.
And on the other, you have this very specific event risk, all centered on AI and tech policy.
So it's not about broad trends, it's about verifying specific events.
That's it. It's a cautious market waiting for a specific headline to make the next move.
Okay, let's start with the technical side then. The New York Fed has kicked off these reserve management purchases, or RMP. What exactly is this, and why is it making so much noise?
Right, so the key thing to understand is that this is not QE, not the big economy-wide stimulus we've seen before.
So it's not about flooring the accelerator.
No, not at all. Think of it more like a very specialized plumbing repair for the financial system. They're buying short-term bonds just to make sure banks have enough reserves. It's a stability play.
A surgical strike, so how big are we talking?
The initial plan is about $40 billion a month in short-term securities.
40 billion? That's still a big number. The market must be paying attention.
Oh, absolutely. The volume is large enough to shift expectations, even if it's targeted. We're watching the execution pace very closely.
And that pace is hitting the bond market. The U.S. 10-year is sitting around 4.13%.
Right, and the 2-year, which is much more sensitive to this stuff, is down around 3.51%.
So the RMP is pushing down those short-term yields, but the long-term inflation worry is still there.
Precisely. The Fed is massaging the front end of the curve, but the market knows inflation is still above that 2% target and employment is solid.
And the U.S. dollar, how's the DXY holding up with all this?
It's staying pretty firm, actually, trading in that 97.9 to 98.6 range.
Which keeps the pressure on commodities and emerging markets.
It does. It just reinforces that theme of risk control right now.
Okay, that brings us to the other major force, the event-driven nervousness. The VIX, our fear index, is still bouncing between 14 and 17.
Yeah, and that's a bit high for this time of year. It tells you there's a specific anxiety lurking.
And that anxiety has a name.
It does. It's Nvidia and DDA. The uncertainty around its H200 chip exports to China is, it's the single biggest variable for the whole tech sector.
What's the core conflict there?
You've got this huge contradiction. The media reports say Nvidia wants to ship before the 2026 Lunar New Year. But they're running straight into a wall of U.S. regulatory review. Congress is demanding transparency on these approvals. It's a political cliffhanger.
So NVDA stock is volatile, trading what, in the $185 to $190 range?
Exactly. And if those H200 shipments get seriously delayed or cut, it sends a chill through the entire supply chain. It's a huge domino effect.
A massive headwind. What about crypto? Is it finding any relief?
Quite the opposite. Sentiment there is extremely fragile. The fear and greed index is down in the 20 to 30 range.
Extreme fear.
Yeah, we're seeing big leverage clearouts amplifying every move. You see BTC around $87, 3K, ETH near $2, 9K, just getting pushed around by flows.
But you did flag a couple of interesting counter-narratives.
Right, in all the fear, you've got companies focused on compliance and global reach.
Right.
Take Circle, the CRCL, for instance. They just got a license in Abu Dhabi.
Which is huge for their USDC stablecoin internationally.
It's a major step. And you see something similar with Coinbase, CoinN, planning its re-entry into India for 2026. These are long-term structural plays.
So where's the actual money moving? What are the big ETFs telling us?
Well, the broad indexes like VOO and QQQM are holding steady, so no mass panic.
But the flows?
The flows tell the real story. Money's moving back into short-term debt and money market funds. People are taking profits and heading for safety.
And gold?
Gold is sitting around $4,500 an ounce. It's probably the clearest signal of the underlying macro uncertainty.
Okay, so let's put this all together for our listener. We've got the Fed's RMP on one side, this NVDA cliffhanger on the other. What's the core strategy here?
It really comes down to three things: risk control priority, event verification, and phased entry.
Meaning keep cash on hand?
Exactly. Liquidity is your best friend. Tactical moves into short debt, money market funds, or even gold ETFs make a lot of sense as a hedge.
And for that NVDA tech risk specifically?
You have to treat the H200 news as, let's say, disclosed but unverified. You only add to positions slowly if you see firm orders and actual regulatory approval.
And if you don't?
Then you need strict stop losses in place.
Yeah.
That news will hit the whole sector, and it will be fast.
You also mentioned a high-risk category to be extra careful with, pre-stocks and HYPE tokens.
Yes, and we need to be crystal clear. Pre-stocks, like Anthropic or XAI, are private investments.
Yeah.
The valuations are opaque and you can't easily get your money out.
And HYPE tokens.
Those are just highly speculative assets. You have huge contract risk, liquidity risk. I mean, you might not even be able to sell when you want to. For any of these, you absolutely must avoid high leverage.
So the market's direction really hangs on two things: the rhythm of the Fed's RMP and the final word on Nvidia's H200 chips.
That's the whole game right now.
All right, here's a final thought for you to take away. Based on the data, the Bitcoin to gold ratio is sitting at about 19.4 right now, which shows gold's relative strength. So given the Fed's technical plumbing operation and this deep policy uncertainty in tech, you have to ask yourself, are we seeing a continued shift back to traditional safe havens until these big supply-side risks like the H200 are fully and finally resolved? Something to mull over as you watch the headlines next week.